Happy Molina Monday. Mortgage rates are down 1% from last month. And everybody wants to know, hey, Chris, why are mortgage rates going down even though the Fed keeps increasing the federal funds rate? I mean, right, it's counterintuitive. Why would mortgage rates go down when the Fed's increasing rates, right? So today I'm going to make this very complex topic for you very, very simple. Let's get right into it. I'm going to make it short and sweet as well. All right. And to understand deflation, you have to understand inflation. Okay. And I'm more qualified than almost anybody to tell you about this topic because I told you inflation was going to be a problem a year before inflation was going to be a problem. And I told you, hey, look, we just had an event that is going to cause inflation. This event is illustrated in this chart right here. The event was the Fed printing trillions of dollars. All right, March 2020. All right, fast forward to the end of the year. All right, 20% of dollars in circulation were printed as a response to COVID. And I said, listen, we just had this event that's going to cause inflation. It's going to have a 12-month lag. Okay, and let's take a look at the charts. So we have March 2020 when the money was printed. Inflation was at 1.5%. And then what do you notice? Inflation stays in the ones up until March 2021, which is exactly 12 months after all the money was printed. Okay. It goes from 1.6 to 2.6 up, 1% over 1 month, which is unbelievable. Okay. And then boom, then you really start to see inflation take control and you have inflation in the 4s, then the 5s, and the 6s, 7s, 8s until June 2022, where inflation gets to 9%. Okay, fast forward to November 10th, which was the most recent CPI readings. All right, and inflation came down. Okay, so October's readings came out November 10th. All right, and I've been telling you guys about November 10th for over a year. And that was the first sign of inflation coming down. And that's the day, November 10th is the day that marks mortgage rates starting to improve. Okay, so you have the government printing money that leads to inflation. Okay. And then the inflation, you can actually pick up on it after 12 months of the event. All right. It's the same exact thing when it comes to deflation. So here you have in March 2022, this is when the Fed started raising the federal funds rate. Okay. So you have a money tightening event. Okay. Money tightening event. And historically, ladies and gentlemen, it takes 12 to 18 months for deflation to occur from when the Fed starts raising the federal funds rate. Okay, so you have March, and then you have inflation start to come down November. Okay, that's a 10-month lag, but remember it's 12 to 18. So we're just getting right into it, ladies and gentlemen. And here's the thing about inflation. All right, it is a year-over-year reading, and we have all these elevated numbers in 2022 that are going to be replaced in 2023. And these inflation numbers are going to come down. You also have the supply chain, which is getting a lot better. Used to cost $20,000 for a freight from China. All right. Not including the cost of the goods, but just $20,000 to get the freight here. Now it's back to about $1,000. Okay. It's down over 90%. It's going to start getting better slowly. Okay. But then you also have these elevated numbers that are going to start to get replaced, ladies and gentlemen. And that's exactly why Fannie Mae predicts in their 2023 interest rate forecast, okay? Fannie Mae predicts Q1 mortgage rates are going to be 5.7%, Q2, Q3, 5.6%, Q4, 5.5%, okay? So even though the Fed is going to keep raising the federal funds rate, you have to keep in mind that inflation has a higher correlation to the increase or decrease of mortgage rates than just the federal funds rate alone. Okay. And we had such high inflation that took quite a while for it to be even picked up on the charts. Now we have those high numbers that are going to start being replaced. November was that month you really wanted to look out for. That occurred. Mortgage rates started getting better, but it's not going to happen overnight, guys. Okay. Mortgage rates might even go up temporarily this month. Okay. But then guess what? They're going to start trickling down, trickling down, trickling down. And guess what, ladies and gentlemen, that's going to be a great thing for real estate. And here we are, not to toot my own horn, but I also told you, ladies and gentlemen, that when the Fed begins raising the federal funds rate, get out of the stock market. Get out of the stock market, okay? And I was 100% correct, okay? Real estate is a much safer hedge against inflation. When the Fed is raising the federal funds rate, you have a cash flow component. But then historically, if you look back and you compare asset classes, stock market to real estate, when the Fed raises the federal funds rate, stock market goes down 30 to 50%. Real estate is untouched. It's untouched, okay? In 8 out of the past 10 times the Fed raised the federal funds rate, real estate actually went up, okay? So side by side compared to real estate, much safer investment. Anyways, ladies and gentlemen, I just wanted to break down that very complex topic for you in a very, short and sweet way. How I would concise that into, really one sentence is when you have an inflationary or deflationary event, all right, the effect on inflation readings takes 12 months, all right? And now we're at that 11-month mark. Mortgage rates have been getting better. So just hang in there, ladies and gentlemen. You're going to be very happy in 2023 because if rates are in the fives, everyone's going to be a very, very happy camper. Now, with that being said, ladies and gentlemen, let me know if you need anything at all. And when pricing out loans with one-stop mortgage compared to cross-country where I was at before, guys, we have cross-country beat by 100 basis points. Okay, so what that means is $500,000 loan amount with cross-country. At one point, you're going to pay at least $5,000 in closing costs just for the interest rate itself. At one stop, you get the same rate, no points, and we're going to wrap in the underwriting fee to that rate. That's going to save you an additional $890. It's a no-brainer. You got to be as competitive as possible in this market with rates. All right. And that's why One Stop is the best. Give me a call. Let me know if you need anything at all. 561-801-0260. Happy Molina Monday. Molina out.